Tonight, a massive wave of U.S. and Israeli strikes on the Iranian regime.
The United States just launched the largest military operation in the Middle East since Iraq.
Iran escalated its retaliation in the Middle East overnight.
5,000 strikes.
Iran's supreme leader is dead.
Iran's supreme leader, Ayatollah Ali Khamenei, is dead.
Oil just broke through $90 a barrel.
Catastrophic consequences for oil markets.
The Strait of Hormuz, where a third of the world's seaborne oil flows through every single day, is effectively shut down. Ships are getting blown up and hit with drones, and every trader and investor who has money invested in the stock market is all wondering the same thing. What does this mean for my money? So I went back and studied every major US military conflict since 1941. I'm talking Pearl Harbor, the Gulf War, September 11th, the invasion of Iraq, Ukraine, and the Israel-Iran strikes that happened like 8 months ago. And what I found was there's a pattern to these things. See, look, every time there's a conflict in the world, you turn on the TV, CNBC's got markets in turmoil on. God forbid you go on Twitter or X, because you don't know what's real. There's fake videos, there's AI, there's people telling you to sell all your investments, there's people telling you to buy the dip. It's just chaos.
But the longer this goes on, the more volatility there's going to be, and consumers are going to continue to see prices go up.
And I get it. War is scary, and it should be, but that doesn't mean that you should panic. And as somebody who's been actively trading and investing for the last 13 years, I can tell you this much. If you can be the type of investor who can keep their calm and keep their head when everybody else is panicking, that, my friends, is where the real money is made. So let me show you exactly what happens during these situations, and then I'll tell you how I'm trading. Rewind the clocks back to December 7th, 1941. Japan decides they're going to attack Pearl Harbor.
We have witnessed this morning the distant view, the battle off Pearl Harbor, and a severe bombing of Pearl Harbor by enemy planes.
And the next day, the Dow Jones dropped about 3.5%, which in today's standards doesn't seem like that crazy of a drop. But in 1941, this was a massive move. But in terms of markets, here's where it kind of gets interesting to me. The market did not just dip for a couple days and then bounce back. No, it continued to sell off for about 4 months. The market dropped around 20% total from the attack on Pearl Harbor, but then it bottomed in April 1942 and began to rally. Stocks gained about 8% ending 1942, 14% in 1943, and another 12% in 1944. And by the end of World War II, the market had just about doubled from that 1942 low. And that was because at the time, war was not necessarily a bad thing for the economy. War meant government spending, war meant manufacturing, war meant jobs. The economy essentially mobilized, and the market followed the money. Now fast forward to 1950, North Korea invades South Korea, and the S&P falls almost 5% in a single day. Not only that, but over the next 2.5 weeks, the S&P fell about 12%. Now if that sounds like a crash, it's because it kind of is, but bear with me, because over the next 2 months, the market recovered all of those losses and then some. And by the time the Korean War ended in 1953, the market was up almost 30% from the day of the invasion. So same pattern as World War II. Initially, you get some fear that sends the market lower, fast recovery, and then years of gains. The pattern is already revealing itself. And I know what some of y'all are thinking at this point. What about Vietnam? You see, Vietnam is a unique case because there was already a broader economic mess going on that had more to do with the 1973 oil embargo. There was stagflation. There were all sorts of economic problems that were not necessarily correlated with the Vietnam War itself. But even then, from the time US troops were actually deployed in 1965 until the end of the war, the S&P had still gained about 28%, which over the course of 8 years ain't very good, but we're talking about some of America's darkest days during this time, and the market was still positive during that war. Which still, even though there's an asterisk on this one, kind of supports the point. The market will respond to economic fundamentals and not war headlines. August 2nd, 1990, Iraq, under Saddam Hussein, invades Kuwait.
Financial markets around the world were hit as oil prices soared.
And the first thing that happened was oil prices went through the roof. Sound familiar? The S&P 500 dropped about 13.5% over the course of a few months, and it was scary, I imagine. I still wasn't born at the time, but I know people were panicking. You get an oil price shock, you get recession fears, and nobody really knows how long these conflicts are gonna last. But here's the most interesting thing about this one, and remember this because it's very important.
Tonight, the battle has been joined.
By the time the United States had entered this conflict in January 1991 with Operation Desert Storm, the market had already bottomed. And that's because markets, even in today's day and age, it hates uncertainty more than bad certainties.
Could it happen? I've no idea. Is it possible? Absolutely. Is it likely? No one knows. That is the reality here. It is simply a mass of knowns of unknowns.
The market can deal with bad news, in other words, but it does not do well with not knowing what's coming in the future. So 1 year after Iraq invaded Kuwait, the market was up over 10% from the date of that invasion. And it finished 1991 up 26%. 26. Now this one I want to be respectful talking about because September 11th was very different. This was a full-on attack on American soil targeting citizens. And so after September 11th, the stock market actually closed for about 4 days, and that had not happened since the Great Depression. And it reopened on September 17th, and the Dow fell over 7% that day. The S&P was down nearly 5%. And over the course of 1 week, the market lost almost 14%. People as a whole did not know what to expect with not only the market and the economy, but with the military and really America's future as a whole.
The United States military has begun strikes against Al-Qaeda terrorist training camps and military installations of the Taliban regime in Afghanistan.
But even during this time period, one of the darkest time periods in American history, within 1 month, the market had already recovered all of its losses since the attacks. And we have to remember this was happening in the midst of a bigger tech bear market when the bubble burst in 2000. But in terms of the military conflict and recovering those losses from September 11th, it only took about a month in order to get those losses back. And so the lesson here is brutal, but it's honest. And it's that markets, they price in fear faster than any other emotion. Hell, even think back to COVID and how scary that was when people just did not know what was coming. And then think about how quickly we recovered due to a lot of factors and the responses and the government, printing money, and then we suffered with inflation for the next 5 or 6 years. I get it, but the market can reverse those times of panic just as quickly as they fell during those times of panic. March 2003, the United States officially invades Iraq. Now this one's interesting because this was not a surprise. This was not like Pearl Harbor, it was not like 9/11. We knew we were going in there to do something. We had to find them WMDs apparently, but there was months of buildup, and during that, you actually saw the market fall. But the actual day that the invasion started, market went up. The Dow rose 8.4% in the month after the invasion, and the S&P finished 2003 up 26%. And this is the pattern that I was telling you about earlier in the video. It's the same thing every time. It's the uncertainty before and in the very early days of a conflict that the market does not like. This is where you can see very real and very quick declines in the stock market. That's no joke. But once the situation becomes clear, and this is not just true for military conflicts, but any sort of market uncertainty, once the situation becomes a little bit more clear, even if it's a net negative face value, the market can deal with that. It finds direction. It finds clarity. And in the market, clarity beats uncertainty every single time. Now, this is one probably all of us watching this video remember: Russia-Ukraine in 2022. European stocks are getting crushed. Germany and France fall like 4% in 1 day. The S&P did fall, but it was only like 0.5% on day one. Energy prices were up. Everybody was talking about World War III, it's coming, and maybe there was a real possibility of that happening. And within weeks, the volatility had settled a bit, and we had reclaimed a lot of the losses that we had in the market leading up to that invasion. Now, I should preface this with saying, and y'all know this if you were investing, we did end the year lower in 2022. It was a rough year for the stock market. But a lot of that was driven by inflation and rate hikes and Fed policy, not the war itself. So the actual invasion was, yes, a short-term volatility event, but it was the actual macro forces at work that caused the market to fall later that year. And this is critical. People like to blame wars for market crashes or market pullbacks, but if you look at the data, if you just look at the hard data, it just ain't the case. At the end of the day, inflation, Fed policy, and most importantly, how much money are companies earning? That is what determines where stocks move 6 to 12 months in the future. The market is a discounting mechanism. It discounts the future. So the things that you see happening on your TV screen behind you on Monday morning, CNBC, that's not what the market is reacting to most of the time. The market is trying to paint a picture and discount the future, and most of the time, Mother Market gets it right. Which leads me to my last example. This is June 2025 when Israel actually did strike Iran. They were hitting nuclear facilities, the price of oil went up 13%, all the bomb and drone makers, Lockheed, Raytheon, Northrop Grumman were ripping. But very quickly the market realized that Iran's retaliation was really just symbolic. The Strait of Hormuz, most importantly, stayed open, and the MSCI World Index, which tracks the entire world's stock market essentially, it was up over 14% in the 6 months after the war. So that is really the playbook for these military conflicts. You get the panic during the early days and the uncertainty leading up, which creates dips in the market, which ultimately end up recovering. And unless something fundamentally changes with the global economy during these conflicts, these are buying opportunities, not a reason to sell. But I would be lying to you if I told you that this situation was exactly the same as back in June, because it's not. You see, this time around, Iran's retaliation is not symbolic. They're hitting US bases and embassies, they hit the Dubai airport, they're blowing up ships in the Strait of Hormuz. Hell, I'm pretty sure they hit the Burj Khalifa, which makes sense because this time their supreme leader is dead, along with a lot of his posse, which has now created a power vacuum in a country with nuclear ambitions and an actual massive military. So this shit is exponentially broader than whatever happened 8 months ago or last summer in 2025. Specifically around the Strait of Hormuz. Now, here's Iran, here's the UAE, here's the Persian Gulf, and this little bitty strip of water right here is what you call the Strait of Hormuz. You've probably heard people talking about it on TV and the internet at this point. Now, the reason that's important is because so much of the world's oil flows through that sucker every single day. And as of the time of this recording, Iran has effectively shut it down. Now, Iran does not directly control the Strait of Hormuz, but you can control anything with a fucking missile. And that's what they're doing. Shipping containers and ships trying to sail through there, they're getting hit with drones and catching on fire and blowing up. So the question is not, do markets recover from wars? The answer is yes, absolutely yes. The real question is, how long will it last? And what kind of damage will it do to the global economy? And these things are always easy to look back in hindsight and see like, oh yeah, surely this is what you should have done. But in the moment, when you're in the fog of war and the uncertainty is in the air, you don't know, which means you can only trade what you see. And that leads me to the part of this video which is actually most important if you have money invested in the market and you're wondering, what the hell do I do? So the first thing we need to identify is whether or not you are an investor, a trader, or maybe you do both. A lot of people assume that because I actively trade markets on lower time frames that I somehow am not an investor or I don't have investments, when the reality is the vast majority of my net worth is invested for the long term in VOO, the Vanguard S&P 500 index fund. And I use active trading as a way to create additional returns and funnel those back into the larger kind of snowball. Trading is for income, investments are for wealth building. But understand that my strategy for each of these is radically different. As an investor, as we've seen by looking at the data, the answer is very clear. You do nothing. If I'm going to be invested for the next 30 years, my goal is not to, I want to match the return of the S&P plus avoid all the corrections along the way. That's not how it works. You can't get the long-term returns without dealing with some short-term pain. It's just the way it is. And if you're trying to time the market, as in get out of the S&P and then get back in and you're gonna generate capital gains, you have to realize if you missed, I forget what the stats are exactly, I could probably look it up for the sake of this video, but if you missed just the best like 10 days of the market over the course of 20 years, your returns are absolutely cooked. And I'm telling you, nobody, myself included, is good enough to figure out when those days happen, because those days happen in the midst of some of the biggest declines, right? When shit is the scariest. Think back to April of 2025, the tariff crash. The markets were literally crashing. Kramer was on TV on Friday talking about Black Monday was coming. Markets went up like fucking 10% in one day. It was crazy. As an investor, you do nothing. Your goal is to capture long-term returns, and you're not gonna do that by trying to sit out every single correction. Just sit. And as a trader, you need to stick to what you know. Because here's the truth, and it's not sexy. And a lot of people that are on YouTube and want to fearmonger or tell you that you got to position here, you got to go all in here, they're gonna tell you that the key during these situations is to somehow get really active and make a lot of moves in the market. And I'm here to tell you, the best way to make more money in the stock market through trading or investing is to stop freaking losing it. Specifically, stop losing it unnecessarily in situations that you don't fully understand. I've been trading for 13 years and I still have a relatively small core competency in the market in my active intraday trading. My playbook at this point is relatively wide and expanded, and I can get outside of that niche a little bit, but for the most part, 80 to 90% of my trades have to do with small cap, pump and dump type companies. I'm waiting for them to go up 300% and then I short them for, 10% or 20%. And I make my money and walk away. That is my core competency. That's what I do day in and day out. And so I don't take these major political and geopolitical conflicts and situations and suddenly become an expert in those and deviate away from my bread and butter trading strategy and try to trade some crazy stuff, because that's the easiest way to lose money. And so my goal during these time periods is to take a step back, breathe a little bit, separate my investments from my trades, and stick to my core competency. And the good part for me as an active intraday trader during times like this is these do actually provide opportunities in the niche that I'm used to trading. Go look at stocks like INDO, look at stocks like BATL, TPET. These are very volatile, small cap energy companies that are tied to the price of oil that get this crazy intraday volatility, which is great. That's exactly what I want, because I don't necessarily care what the underlying reason is that gets a stock moving. Once it's moving a certain amount, it just becomes a trading vehicle. People just start trading it, myself included, and then it's all about the price action. You're just trading the extremes. You're shorting parabolics, you're buying capitulations, you're shorting failed breakouts, you're buying failed breakdowns. The same patterns that I trade all the time, they just happen more often during time periods like this, so I get a little bit more active. But am I going out and trying to determine what's gonna happen to interest rates and Fed policy and what's going on with I don't know that game. I don't know that chessboard, right? I'm not privy to that information, and so it doesn't make sense for me to be trying to trade that. But you show me a stock that goes from 5 to 33 in a day and then back to 12, well, I can find some intraday opportunities and catch some low risk, high reward trade spots just based on the same patterns that I always trade. It's just the reason for this one happens to be, they're moving because of what's happening in the Middle East. And I will say another thing too, many times during uncertainty like this, it can be very easy to want to go out and just do the obvious thing, which is like, oh my God, I better buy Lockheed Martin. Or, something happens over the weekend and you come in on Monday morning and you're the first guy buying oil that gaps up. And a lot of people did. And if you notice, a couple of weeks ago, oil is now higher because things are escalating. But at the time, everybody who bought the initial gap up in oil, it faded off throughout the entire day. It went from up 13% to almost flat. And so if you were the guy panicking and giving into that knee-jerk reaction and like chasing everything higher, and then you puke it out at the close, and then it gaps up, that is not how you want to trade. You want to be fading the extremes. But again, I always come back to, I would rather miss a move and not lose money than I would chase something, give in to FOMO, trade outside my core competency, and then lose money. Results in trading are not linear. This is not a job. It's not a 9 to 5. The more active you get doesn't mean you're doing more. If anything, it's the opposite. Doing less produces better returns over time. I don't care if you're a day trader, swing trader, or an investor. Warren Buffett talks about the punch card analogy. If everybody coming out of school had a punch card with 20 punches in it, and those are all the investment decisions that you had to make for a lifetime, you would think really carefully about every single one of those. And because of that, you'd probably start making some good investments. Now, Warren Buffett's not a day trader, but really the same thing applies. You want to be waiting for the trades that jump off the screen at you, the one where it almost feels like the market is giving you money. If you're going out and getting active and just trying to trade the action, then okay, you might feel like you're doing something. But in reality, a lot of times the best thing to do is just sit and stick to what you know. And I also kind of hate making this video. I hate when real things happen in the world and our immediate reaction is to figure out what the economic impacts are. I don't like immediately jumping to like money when people are seriously dying, and it's a serious deal. But again, as traders and investors, this is a market moving event, and it is something that we have to pay attention to. And so I'll wrap this video up with saying that history, it does not repeat, but it does very oftentimes rhyme. Anyone that has ever sold their long-term investments, the S&P 500, for example, because they thought it was going to go down further, or they were panicked about the future, it has quite literally always been a mistake. Now, people sell for all different types of reasons. If you needed cash or whatever, that's not a mistake. But if anyone has ever sold in the history of the world because they were afraid the market was coming, the market's at all-time highs. It might be, I don't know, 4 or 5% off the highs right now, but I have no doubt, unless the big bombs start flying, that the market will recover from this. But in the short term, could it go down further? Of course. But does that change the way that I invest? Absolutely not. Does it change the way that I trade intraday? Absolutely not. If anything, it just provides more opportunities. So I'm going to take those intraday trading opportunities, make money if I can, and if I can, I'm going to funnel it back into the long-term investments, which, as we've seen from the data, has a very high likelihood of eventually recovering. I don't know if it'll be in 3 weeks, a month, 6 months, or 2 years, but if you have a relatively long time horizon, rest assured, we will get through this thing. So appreciate y'all tuning into the video and showing love on the trading videos this far. Have a good rest of your day, and I'll catch you right back here in the next one. Peace out, everybody.